Hello everyone, welcome to the live gamma optimizer video. This is the one that was supposed to happen on Friday, and as usual the first question is a sound check and video check. We are in YouTube, so I think that we have a little more delay. For those of you that can type on the window, you can let me know if there is sound right now. I'll wait a little bit for the feedback. Okay, well, so I don't have feedback yet about sound and video, but I'll start anyway. I'll take the risk. I am seeing on my streaming software that things should be okay. Probably is that I don't have anyone in the room right now. Okay, so everything is okay. Anyway, the only reason I am doing this is so there is a recording so you guys can access it later on. So it really doesn't matter how many people we have right now watching the video. So let's see what we have in store for today. So in terms of close positions, we have 3 wins and 2 failures from NAS 350, and it's doing okay. I guess NAS 350 is kind of coming back, and the system is performing good. No changes planned yet for it. It's in line with expectations. The 150 system, on the other hand, I don't think it works. I think that since it came live in October 19, performance dropped to 41%, and I don't think that it's acceptable for something that we're just testing. It's enough test. It's like around 15 trades so far, and I should expect a little deviation from the 60 something percent, but not 41. So it is starting on the performing right off the bat, and I will not be using it anymore. The thing is, I have like several candidates to use. I don't know why I picked this one in particular. I guess I was too conservative. I picked the one with the lowest performance just to be conservative. So I might test a different one this week and see how it goes. So that's in terms of close positions. In terms of market regime, we have, I guess I went too far. Market regime. Okay, now it's okay. So the GT level. The GT level is coming down a little bit, 3,821. It has dropped a little bit since last week, not much, but it's dropping. And we are back to short gamma. And it's interesting because we have a brief long gamma flip last week, and now it's gone. No, it lasted what? It lasted a session or two. So this is like the usual. No, this is exactly business as usual what we have during short gamma regions. We have a long gamma flip that lasted nothing. Okay, so we are back short gamma, and this is the story of 2022, and it's very likely we are going to close the year short gamma as well. The only thing is that we are relatively close to the GT level. No, we are not that far. We are probably 30 points away from it. So it's right there. It's right there. So gamma imbalances are very low right now. And even though we should have high realized volatility because of the imbalances are low, then we should not see that much effects from gamma hedging from option dealers. I don't think that dealers are hedging like crazy at this level. So whatever we are seeing in volatility is mostly coming from organic volatility, but still we should see a little bit of increased volatility, even though it looks really calm right now. It looks around only 14-15%, which is extremely low for this time of the day on a Monday. So I guess everyone is waiting for something. So this is in terms of the GT level and gamma imbalances. Things are actually really low on that front. In terms of volatility, what else can I say? It's like consistently over 20. In fact, it's consistently over like 24, 25. It's 25 for the last month. It has come down a little bit for the last month, and it's 24.66 for the past week, which is slightly higher than we have last week. So those values are terrible values on volatility. There is no liquidity in the market. The market moves massively day after day. No, this is probably 1.5% more or less is what this means. It means that the market is moving 1.5% daily most of the time. But in general, liquidity is terrible. No, I don't think that liquidity providers are coming to this market at all. I don't know what is going to attract them back to this market. And so my whole thesis is that it's going to continue. This is going to continue for a while, for a long time. We're going to see this probably until that day that the Fed decides to provide liquidity again into the credit markets. Then maybe some of it will filter into the equity markets. But for now, it's terrible. The other storyline here is VIX. VIX is 2466, so it's lower than the monthly realized variance, and it's telling us right there that we have negative BRP. And again, this is a mispricing. Why? No idea. I have no idea why VIX is being mispriced. I mean, if I am a dealer, why will I misprice options for 30 days? No, if I have the ability to charge more for them. So clearly there is an external influence right here. There is something else that is forcing the hands of the dealers to misprice volatility, and my hope is that someday we'll know what it was. No? someone writes a book about what happened in 2022 with volatility, with options pricing. But that's kind of what we have right now. No? This is realized variance is very elevated, VIX really low, and it should not be really low. And we can see it here in the term structure. No? You can see the term structure longer term is not that bad. The term structure looks okay. It is a little flat towards the end, but it's inverted in the near term, like massively inverted. No? So we have a massive inversion of on the curve, and I'm pretty sure that the peak coincides with CPI release. No, it has to be because that's Thursday. It's exactly for Thursday. No, the first dot is Monday, then Tuesday, Wednesday, and then Thursday. So yeah, it is very convenient. That's the CPI release, and then everything is inverted after the CPI release. Now everything there is an inversion going up for like 20 days, and then things kind of normalize. But of interest is that the absolute levels of volatility are actually low. No, they are like 4 to 5 full volatility points below to where they used to be. Well, last week they started coming down a bit last week, and now they are coming down even more. No, so it's kind of interesting that risk is being mispriced across the whole term structure. No. Also, it's very interesting that we have elections tomorrow. No, we have midterm elections, and if you look at this graph, the second data point is actually the lowest, which is the one that expires tomorrow. So probably the Wednesday one, which is the following, is also very low. So I guess at least in terms of volatility players don't care about the elections. They really don't care about the elections. The thing that volatility players are looking right now is for the CPI release, and that's it. No, I don't even think that there is any Fed meeting. There might be an extra peak. I don't know when the Fed meeting in December is, but it might be a small peak there. So anyway, in this chart, again, it seems that dealers really are trying to position for a Santa rally. They're trying to position for like, let's say no low volatility, but a lower volatility than usual. No, so it's a very interesting term structure, if you ask me. No, I will not be pricing the term structure at this level, and in particular, given how the Fed has corrected the market a couple of times already in the last few months. In the last 3 months, the Fed has corrected the record, and so the market has to reprice risk all the time. So I think that I don't think that volatility players are pricing correctly right now, risk right now. There could be a play here. I'll be tempted to play long volatility, like to play volatility actually going up like far away on the curve, because that's where most options are more sensitive to Vega, like 100 days or 150 days. Then we have tons of Vega sensitivity. Maybe there could be like a little play there for towards the end of the year, in particular with CPI. Most of the pricing is happening just around the CPI release, but if something comes really a negative affecting, the whole curve will go up, and then we could make some money on the way up of the curve. No, at least like if we pick options that are really, really far away, probably 1 year or 2, maybe we could do some kind of calendar spread, and we will get a little bit of money there. So we'll see. Just remind me of doing something like that. Realized variance. Oh God, what else can I say about realized variance? It is terrible. If you notice, I think when I do the YouTube presentation, you guys can't see my mouse. I don't think you can see my mouse. But if you notice towards the end of the chart, you see the spikes in realized volatility. This is intraday realized variance, and you can see the spikes are really, they are coming more or less in synchrony. So we have spikes above 30 all the time, and they coincide with the Fed. No, I think they are coinciding with some kind of macro releases, either the Fed meetings or CPI meetings or CPI numbers or employment numbers. No, so you can see the liquidity is horrible, and it was horrible last week. You can see one of those spikes. The interesting thing is you can also see the red line, which is VIX, and you can see that VIX is just coming down no matter what the blue line is doing. The blue line is going up massively, and then VIX doesn't care anymore. So this is the mispricing. I am trying to figure out what is going on here. No, this is a tremendous mispricing here in terms of implied volatility versus realized volatility. Clearly, we have no liquidity. We never had liquidity in 2022, and yet the volatility players, the ones that sell future volatility, they don't care. They don't seem to worry at all about what is going on in that space. So, and I guess my whole, this is not technical. This is just my guess is that liquidity providers will not be back until the Fed finally starts providing liquidity in credit markets at some point when they reverse whatever they are doing to fight inflation. And I have a question. Let's see what the question is. Regarding mispricing VIX, is there something structural related to higher RB? Historically, are high RB regimes accompanied by a strong BRP? Well, that's a good question. Historically, when we have high realized volatility, then we notice that the VRP, the variance risk premium, gets negative. No, like most of the time, players are taken by surprise, so they were not pricing elevated realized volatility, and then therefore, variance risk premium suffers and it becomes negative when the realized volatility is coming up. But then they adjust really quickly, and then they start overpricing. Volatility, and then they overcorrect. They price substantially higher. So then down the road, you will notice that variance risk premium becomes really positive, like nicely positive. But this year it hasn't happened. This year there hasn't been any overcorrection, and we can see it in the next chart. So let's use this. This is a great excuse to transition to the next chart. And you can see in previous years, for instance, between 2020 and 2022, you can see the crash. You can see the COVID crash, and you can see that variance risk premium went negative because it was a surprise. It took everyone by surprise, and you have negative variance risk premium around that time. But then they overcompensated, and then you can see the red line going substantially higher, like 200%, like 3 times more expensive than actual volatility. And that's how it works. They overcorrect, and then it kind of drops a little bit, and then they overcorrect massively. So every time that variance risk premium tries to go negative, dealers overcorrect and make it positive. However, in 2022, look at what is happening in 2022. We have like a decent variance risk, like decent, more or less decent at the beginning of the year. Then it went negative, and there was no overcorrection. It was just a little correction on the price, and then it went negative again, and then so then they corrected, but it was a brief peak, and then again massively negative. And none of the corrections have been overcorrections. It seems that dealers have not been overpricing volatility in response to negative variance risk premium, and that's the mystery. Like why they have not done it? Why they have not overpriced volatility like in all of the previous years? You look at even in 2021, between 2021 and 2022, BRP was never negative, just at the very end. At the very end of 2021, we got a little bit of negative variance risk premium, and then it got overcompensated. So why 2022, they had been struggling to create positive variance risk premium, no? And I have here a speculation, maybe high RB regimes, volatility historical underprices, by our metrics at least. It could be, but I mean, to me, is the thing that is surprising me is like, yes, okay, so we have an underprice and we lost some money, but then we learn from it and we readjust and we don't suffer again. But in 2022, like, it seems to be consistently being born, no? Like okay, we screw up, we underprice volatility, but we are not learning from that. No, this seems to be what is happening right now. Like, you can see it, right? That you can see it that even in the second half, the only positive VRP around this was the summertime. No, so because in the summertime the market doesn't move at all. So in the summertime, at least there was a little bit of variance risk premium. Nothing comparable to the previous years when it almost touched 200% or even more, like more than 150. This time barely, like twice, the overpricing, and then during the fall, nothing. There is no correction, and I guess my whole hypothesis is that there are external forces that are tying the hands of dealers. If I were a volatility dealer, I am not gonna do this. If I were dealing in volatility or dealing with options, I will make sure that I'm going to make tons of money on those things. I'm not gonna give away risk here. So my thing is there is a new type of player in the market, and this player is really short in volatility. This player, for some reason, it has been selling volatility like crazy and is putting a ceiling on how much dealers can overprice. And this player in particular doesn't care at all about variance risk premium, so he's not really selling variance risk premium, he's just selling volatility. And maybe this is where we talk about, maybe this is a dispersion trader that doesn't care about what happens in the index itself. Maybe he's long volatility in other places, no? Maybe he's long volatility on the stock side, and then he's making a good money there, and that's why he can short here. So I don't know. Maybe that's what he's doing. Another comment could be big players have their own options market, like the direct pools of privately buying and selling stocks. Could that account for the VRP not behaving as expected? The market is where we don't see. No, the options are very interesting. At least in particular index options. No, index options are patented by CBOE or CBO. No, the Chicago Board of Exchange, the exchange used to be known like that. No, CBOE has a patent on on SPX options, and they can only trade on that exchange. So they have a full monopoly of those options. So it's not that players could be trading them. Even if they trade them over the counter, they have to offload risk on the only exchange that actually trades them. So I think we are seeing the flows. My guess is that there is something else, and there is something going else, like a meaningful program, selling program that is happening in the index options. Maybe they are selling index options to finance individual options. So they are selling index gamma to buy stock gamma, and they are making tons of money this year. I bet they are making tons of money, but they are depressing the options of the prices of index options. In 2020 and 21, where the pricing corrected, RB was also coming down. I mean, yes, I guess it could be like that. It could be like, but it's still 2022 is not consistent. Even if I reprice volatility and then RB keeps increasing, then I reprice volatility and RB keeps increasing, then RB becomes always trailing the market. No, I'm always trailing the market and I'm going to make money. But that's not the case in 2022. 2022 we don't have infinite realized variance. It's not that it's runaway realized variance. No. You can actually see it right there is the blue line. No, the blue line is the realized variance. Has been really contained. No, it has had some spikes, but it is not that it's completely going all the way to infinity. So it's behaving like it's supposed to behave. It's clustering and it's going up and down, going up and down. Like, how hard is to price volatility to cover that? It's not really that hard. It becomes hard if we have an external player that is selling it no matter what. No, then it becomes hard. But independent of the reason, the net effect of this slide is that there is not a decent strategy here that can be accomplished by selling index options. Like selling tails has not worked in 2022. Not a single strategy that relies on that will have worked. And the opposite is true. Like the only strategies that would have worked nicely have been strategies that are playing long gamma. No? Like, in fact, we play a long gamma trade last week, and it kind of worked. That was surprising. The trade actually worked because I think they were not pricing correctly the risk. So we saw it on first hand with the little lotto trade we did for the Fed meeting. Anyway, so it's a mystery to me. It will be really nice if we can see some kind of academic paper showing like why volatility has been so underpriced in this year. Okay, so going into ambiguity. Ambiguity, nothing to do there. It's like, I just included, nothing to see here in this space is included for completeness. It's included just so you guys can see that it's very low and there is not a factor right now. I have a question from Sam. What about BRP on much short-term time horizons? That's a good question. That's something that, like right now, this chart is only showing the 30-day volatility. And yes, maybe there is positive BRP at different time frames. Maybe that's where everyone is focusing. Maybe for some strange reason, then we are focusing on like 1 week or 2 weeks, and maybe there is BRP. It could be one of the reasons. That will be interesting, no? Like someone does the whole analysis and find that pretty much BRP migrated to a different time frame. Maybe we do it and we found that like 2 or 3 days variance or extreme is actually really fat. It's fatter than it used to be, and the 30 days is like flat because the action now is happening in shorter time frames. That could be one of the explanations. Okay, so on ambiguity, we'll see. I have it here just to keep an eye to see when will be that mythical time when it's going to start going up again. That's pretty much the only reason I have ambiguity right now listed. Okay, in terms of the trade plan, remember the NAS 350 is the only official system of the room. 150, the test we did, it failed. There is no other way to say it. The test failed. I lost like a couple of $100 there, not that much. It was a good test, but it failed. And I will explore other nets, including today. So if I generate, like I might change the widget today to use one of the other nets that I have been testing since October 4. I guess that's when it was introduced, like a month ago. And I don't know, I could have picked any one. I went for one, and the other net has performed like 80%. So as usual, I picked the wrong one, I guess, for the room. So of course, at that time, you don't know what net is the one that is going to perform. So I'm going to do another quick experiment with a new one and see if that one is more stable. Okay, so let's go to the variance center and see what we have here. So in terms of the GT level, you can see that it's coming down a little bit. And you can also see the imbalances are very low. The imbalances are extremely low. Only 622 million and 13 billion on the way down, and that's because we are only at this time we're only 20 points below the GT level. The market is really trying really hard to flip long gamma today. Maybe that's what they want. Oh, I have a question here. What is the criteria for the 150 fail success? The criteria was to have the expected accuracy. So on all of the trades that we did since I think I posted here on the presentation. Let me switch back to this one here, and I think we got 41% accuracy since October 19 when we started testing it, and my target was 65, 66, like something around that area. So clearly we massively underperformed the target, and then that's where I say that the net failed. No, the experiment for this net failed, and it should not have failed. It should have continued with at least like hugging the line of accuracy, but it didn't. No, and I think 3 weeks was more than enough to test it. So and it's sad because I have another one in parallel that had like 80-something% during the same time period. So that's kind of sad that I went for the one that didn't perform. But so it is what it is. I don't marry any of these systems. I just, if it doesn't work, I discard them, throw them to the trash, and then look for something else. So coming back to the gamma imbalances, very low gamma imbalances, we are not supposed to see much volatility in the near term due to that. Also, we are so close to the GT level that we could be neutral for all practical purposes. Now, remember, the GT level is an approximation. Maybe we are so close that we could be basically in a neutral area. No? In terms of strike gamma imbalances, we have a bunch of calls expiring today, but a bunch, like tons of calls that are providing enough gamma to slow down the market. Now, like we have all of these strikes here, and those are like options expiring today. I guess a lot of people went heavy into calls. So those are providing long gamma for today. And as the market goes up, right now is on the important psychological level of 3,800. And as the market keeps going up to that level, it's going to slow down massively because of the long gamma thing. Like there is nothing here that will allow the market to keep going. All of those barriers will start making the market slow down because it will require selling from dealers. So dealers will have to start selling, hedging by selling. So market is going to slow down massively in the area above 3,800. So at least that will put a ceiling on the move up. You can see here in historical realized variance a very interesting thing. You can see the Fed meeting. You have a massive Fed meeting. You can see massive volatility here. That was crazy, and then it kind of came back, and so that's the only thing I wanted to show you. Also, the inversion that usually VIX runs always above realized variance, and a very few times we have these flips, and in the past they have always served as bullish indicators. Like the market has tended to raise after something like this happens. So it is happening again. I have what is the time horizon for that chart? Like what chart, the historical realized variance or the gamma imbalance chart? I mean, the historical realized variance is only 20 days, 20 sessions, so it's like 1 month. Gamma imbalance is not, there is no time, it's only strikes, and they are using the gamma for like all of the options now, this being displayed. So we are seeing low realized variance today, 1453. That's surprising for a Monday, surprising for a week, and that's it. So, and I have a question: when is a good time to take ULG trades? Like never. I have the ULG tab here just because I don't know. I guess there are some members that still use it. It's just because you guys keep telling me like, please don't delete this, please don't delete that. I don't even use any of those ULG trades anymore. Like I don't use them. If any of you are using them, just let me know. Those are not official. I don't do them. I discarded them like probably 2 or 3 years ago. But I guess I keep them there just because I know some people are using them. So I will never trade them. In terms of the trades for today, okay, remember NAS 350 is the official system. So this is, I expect a trade towards the end of the day. This particular trade here, the NAS system, this system, I'm gonna unplug it like on the back, so you will not notice, and I'll plug the new one. So it will become a new system that's testing for just a mere coincidence. They are all having the same bull signal today. Both of them, they are bullish into tomorrow. So you will not notice a change of signal, but underneath we will be using a different NAS 150, so one that was trained with a completely different neural net. Is very similar periods. It's just different neural nets. And that's it, pretty much what we have here in the Variance Center. Coming back here. That's it. I think that was a short presentation. I tried to do this on Friday, but we could not do it. My expectation for this week, the CPI is on Thursday, so I guess from here to Thursday the market could be free from external events. So volatility should be a little subdued in the next few days, in particular if the market remains around that the area, around this area, because you notice that the gamma imbalances are very low. So in terms of gamma hedging, we should not see that much volatility, So the market could just drift up and down a little bit here and there. So I don't expect much until Thursday. And I have a question: what NAS stands for? What does NAS stand for? I think what was the thing we agree? It doesn't stand for anything. I think we call it the neural augmented system. That's kind of, we settled on that one unofficially. So like it's one of those acronyms that don't have no meaning. It's just to differentiate it from the previous BRP system. And I have a question: do you use 2017 data for in AS150? No. Like all of the nets are only going back until 2018. So that's the thing. Anyway, guys, thank you very much for attending. I hope to see you in the room, and let's see if we can make some money this week and get these systems back on track. No, let's see if the market allows us to do this, and hopefully the CPI release doesn't throw a wrench into these things. I hope you guys have a great day and see you in the room. Take care, everyone.